In this video, I'm going to expand on a discussion in my last blog post published on November 1st about dividend reinvesting. A link to my post can be found by clicking South Gent, which takes you to my profile page here at YouTube, which has the link to the post. I discussed briefly in that last post the criteria that I use to determine whether or not to take a dividend payment in cash or to reinvest it. An important consideration in that analysis for me is simply my age. I do not have that much longer for reinvestments to compound growth, and compounding growth in the number of shares owned that results in more future dividends is the most important reason, in my judgment, for reinvesting the dividends. If I was 25 and wanted to buy General Mills, for example, symbol is GIS, a beaten up dividend growth stock that I do own, the reinvestment of the dividend would make a lot more sense due to the long-term compounding effect over 40, 50, or 60 years. Another important consideration is that I expect General Mills to survive over that period of time. I use the dividendchannel.com website to calculate the impact of dividend reinvestment as opposed to taking the dividends in cash. The data goes back to January 1st, 1995. You can find that website simply by Googling dividend channel drip return calculator. Taking General Mills as an example, the total annual average return with dividends reinvested starting on January 1st, 1995 through last Friday's close was 7.65%. That is the annual average total return. And that has been restrained down significantly by recent poor stock performance starting in 2023, which I will go into in a minute here. The total return over that period was 844.52% over 30.44 years. Without dividend reinvestment, the calculator came back with an annual average total return of 6.47%, with a total return at 575.3%, substantially less than the 844.52% with the reinvesting the dividends. By recent poor performance, I am referring to the fact that I was selling this stock starting in September 2022 through March of 2023 at over $80 per share. Discussions and snapshots are in my blog post. Remember the dates, September 22 through March 23. What was happening to input cost during that period? The stock closed at $46.41 on October 31, just to highlight the problem here, down from the 80s, 80 to 87 or so that I was selling the stock back in September 2022 through March of 2023. This is not brain surgery to figure out what caused the decline in the General Mills stock price. It's really just a matter of common sense and knowing some basic information. During that period starting in 2022, input cost for companies, including General Mills and almost all packaged food and consumer staple stocks, rapidly and significantly increased. When the companies raised prices to recoup some of those higher costs, unit volume declined as consumers purchased less of the product, refrained from buying any of the product, or substituted cheaper alternatives. The end result was compression of profit margins and the flatlining of GAAP earnings growth to the extent it existed at all. The new input cost inflation problem for many U.S. companies are the Republican tariff taxes. There's already a lot of bad news baked into stock prices of consumer staple and packaged food stocks, which I mentioned in my last blog post. I believe that the worm will turn in favor of those stocks, but it is impossible to predict when, since they are still trying to deal with the input cost inflation problems and the impact of input cost inflation on profit margins and the volume demand in units. There is a potential benefit also in averaging down with those reinvestments during periodic market meltdowns or during a period when the company is experiencing problems, which is the case now with packaged food and consumer staple stocks. GIS is at least making, in my opinion, some good moves over the past several years with moves into organic food, and pet treats. After taking into account my age, which limits the compounding effect, the most important criteria which must exist for me to reinvest the dividend is the willingness to buy more shares at the likely reinvestment price. That means the stock will need to be in my or close to my fair value range on valuation metrics, and I use traditional valuation measures to determine fair value ranges. If I view the stock as overvalued or the dividend yield unattractive at the reinvestment price, I would just take the cash. This requirement results in some changes in the dividend option, which can easily be changed at the online at my broker's websites. If that requirement is met, then I will, in addition, require two of the following criteria to be met before reinvesting. And this is done because of my age. I would be more lenient if I was 25. First, if I own the stock in two accounts, which is the case in many of the stocks that I own, I will frequently take the dividend in cash in one account and reinvest the dividend in the other. Two, there's a tax advantage to the dividend compared to the money market fund dividends or the T-bill interest. And the yield on the shares purchased with dividends will need to be higher than the 3-month Treasury bill yield or the sweep account money market fund yield, where the cash payment to purchase the stock would be sourced from. I will own the same, as I said, I will own the same stock in two accounts and take cash in one and reinvest the dividend in the other. That's one way to cope with the problem that the stock may enter into a bear market in the limited time that I have left on this earth. I also summarize in my last post my decision-making process in buying Treasury inflation protected securities in my Roth IRA accounts rather than the non-inflation protected security maturing at about the same time. I may publish another video here going into more depth on that process.